What's up guys, Jake here. Have you ever been told that gold is a good investment, a hedge against inflation? In this video, I'm going to show you exactly the math behind why this isn't true and you should not be investing in gold. Now, broadly speaking, if you want to invest in gold, there's really four ways. The first one is to own physical gold, and this is very difficult or problematic. One being that whenever you buy it, you're probably not going to get the true value of what gold is selling for. To get it from a store or to order it online, you're going to lose a couple percent. So immediately on your investment, you're underwater. Next, you're going to have to pay to ship it and then pay to store it. If you store it in your house, you risk losing it due to fire or potentially theft, so you might need to insure it. If you store it in a bank security vault, that's going to cost you money. And then once again, if you ever want to sell it, you're not going to get the true value for what gold is selling at for a store to take it off your hands or to be shipped back. Once again, it's going to cost you money. The second option is to buy an ETF or a fund that holds gold. And this is good because you're getting the exact price of the gold for whatever it's trading for. And there's a professional or an expert on the other end verifying, certifying that however many shares you purchased, that's how much gold you're holding. But the problem with that option is you don't physically have the gold. It's not in your possessions should something dramatic happen to the economy or the government. The third option is gold miners. And with gold miners, you're really just investing in a company. And this can be boom and bust, guys. If you want to invest in a gold mining company, when gold prices are rising, they're doing a lot of mining. They're trying to get as much out of the ground as possible. You can make a lot of money on this company, not so much on the gold. However, if gold prices stagnate or decline, then the gold miners are going to reduce their production and they're not going to be mining as much. So the price of the company will drop. Basically, you just assume the same risk you take whenever you buy an individual stock. Option 4 is to trade options and futures in gold. I highly don't recommend you do this unless you're a professional. Now, before making any long-term investment, you should be checking the past history, the past performance of that investment. So let's do that together, and we'll just go on Google. If you Google price of gold over time, let's scroll down to this website, macrotrends.net. And this is going to give us gold prices over the last 100 years. Now, it's going to give us this logarithmic scale, so let's uncheck that. It's also adjusted for inflation over time, so let's uncheck that as well. So here we are. This is just the price of gold over the last 100 years. And it's showing the recessions in the gray boxes, but we don't care about that. So for the longest time, all the gold in the country was basically controlled by the government. The price was set at $35 an ounce. Then in 1970, this was under Nixon, he officially got us finally off the gold standard, and the government started selling the gold to anybody who wanted to buy it. And this created a market for it, and there was true supply and demand prices. So the price of gold, how much people were willing to pay to own 1 ounce, started going up. So we'll just go back to the beginning of when the market prices for gold began. So this is January of 1970. It was at about $36.56, and it shot up to last month, $1,904. That's got to be pretty good, right? Well, when you actually do the math and you calculate it, that is a 5,209% return over a 51-year period. Is that good? What can we compare this to? So let's compare how gold has performed the last 50 years against the S&P 500. So if you want to find an S&P 500 historical calculator, here's the top website, and we're just going to input these dates. So let's input starting January of 1970 to May of 2021, and we're going to calculate. Now, the total return of the S&P was 4,500, but that doesn't count the dividends. Index funds will pay you a dividend, and if you reinvest it, it compounds over time. So in the last 51 years, the S&P 500 with dividends reinvested has returned a 19,631% return. So just think about that comparison. Over the last 51 years, gold has given a return of 5,209, and the S&P 500 index fund has given a return of 19,631. So this graph I showed you is not adjusted for inflation. So when we factor in inflation, the purchasing power of buying that gold, we'll click on that. Gold, when adjusted for inflation, actually peaked in 1980. So think about the purchasing power of $1 in 1980. People were paying more for gold then than they are today. Meaning, gold is not a hedge against inflation. If you hold it, you're barely beating inflation. Now, of course, it always depends when you bought it. If you bought it in 2000, then yeah, you're beating inflation. If you bought it in 1980, you have yet to beat inflation over the last 41 years. Now, this definitely might be confusing for you because people swear that gold can outperform the market during some periods. So let's go ahead and compare gold versus the S&P 500 index fund with dividends reinvested. So we got 5,209 versus 19,000 since 1970, 51-year period. Since 1980, gold has only gone up 287%, and the S&P 500 index fund has given a return of 10,660. So this is over a 41-year period. Since 1990, gold has now given you a 465% return. How is this possible? It's because the price of gold between 1980 and 1990 went down. So if you bought at 1990, you would have gotten a higher return than somebody who bought in 1980. This is supposed to be silly, guys. The S&P 500 gave a return over the last 31 years of 2,211. Since 2000, once again, it went up because the price of gold between 1990 and 2000 kept going down. So if you had bought gold in 2000, held it for 21 years, you'd be up 670%. And with the S&P 500 index fund, you'd only be up 332%. So yes, gold during this select period of 21 years between 2000 and 2021, gold outperformed the S&P 500. But you have to factor in that this includes the dot-com crash in 2000, this includes the 2008 recession. So yes, over this isolated 20-year period, gold did outperform the S&P 500 index fund, but when you look at a 30, 40, or 50-year period, it's not even close. And then finally, when we look at the last 10-year period, so this doesn't include the dot-com crash, this doesn't include the 2008 recession, from 2010, gold is only up 57% over 11 years, and the S&P 500 index fund is up 358%. And if you want to look at a shorter time period and reflect on the pandemic March collapse in 2000, gold still doesn't do that well. So this dark blue line is gold, and the light blue line is the S&P 500 index fund. This is over the last 2 years. So yes, there was the dip as everybody was panicking about how big of a deal is this pandemic going to be. Gold went down as well, and gold did better in the short term as people were uncertain. They didn't know if they wanted to be in the stock market. But then in January, the index fund overtook gold. And the return over the last 2 years for the S&P 500, 43%, for gold, only 27%. And if we zoom out to the last 5 years, you can see the disparity. So when the S&P dropped, it actually dropped to the same level of return that gold was giving and dropped. And then over the last 5 years, S&P is up over 100%. Gold is only at 34%. So if gold is not a good hedge against inflation, if gold does not protect you when the market goes down, what does? And people are not going to like this answer. But just buy an S&P 500 index fund. This thing is freaking amazing. Just reinvest the dividends and ignore it. If the market goes down 10, 20, or 30%, don't sell it, leave it alone, buy more if you can. This sucker only goes up. We can reverse test the performance of the S&P 500 going back 140 years. This thing only goes up. If you're worried about inflation, it's baked into the cake of all of these companies. You're diversified across 500 companies. When the price of goods and services, when the price of building and materials and resources goes up, the valuation of all of these companies goes up. They raise their prices, they make more revenue, they become more valuable, your stocks become more valuable. If you want to buy an S&P 500 Index ETF, you can go with VOO, this is Vanguard, IVV, this is BlackRock, or SPY, that is State Street. So why do people buy gold? Why do people talk about gold? Why is gold such a big deal? Aside from the historical significance where gold has always been associated with royalty or a reserve currency backing up paper money. But in 2021, it doesn't make any sense. When you invest in gold, you're really investing in fear. The people that are all in on gold think the government is going to collapse. They think the economy is going to collapse. They want to have this physical asset to, I guess, smuggle out of the country, should the government collapse and they've got to flee to a new land to start a new life. Like, it just gets kind of silly when you think about it, because when we look at history, gold has not been used as a currency when a government or an economy collapsed since the fall of Rome. So you think about the American Civil War. When the Confederacy was falling and their money became worthless, people did not start transacting in gold. They started transacting in Union currency. When Iraq fell and the economy, the money became worthless, they didn't start trading in gold. They started trading in other paper currencies. So realistically, for gold to become the new medium of exchange for goods and services, every stable currency in the world would have to collapse simultaneously, and no other system would have to become more relevant. I just don't see this happening, guys. I don't ever see gold coins being the medium of exchange. Like, I think we would more than likely just go to a barter economy where we would be trading physical goods for other goods or services rather than risking it, minting and then trying to transact with gold coins. It's just never going to happen again. And I think the final dagger in the argument that gold is a good investment is cryptocurrency. I think cryptocurrency has replaced this fear investment factor. If, for whatever reason, you think your economy or your government is going to collapse and you might need to flee the country to start a new life with your family, it's much easier to take a jump drive with your cryptocurrency on it than it is to bring, pounds and pounds of physical gold or silver. So cryptocurrency really has replaced the allure of investing in gold for these people with these doomsday predictions of the future. But Jake, what about diversification? People are always saying you should be well diversified. Well, Warren Buffett likes to say wide diversification is only required when investors do not understand what they are doing. And yes, I understand that precious metals can be recommended to you to just basically throw a couple percentage points in everything. But when you think about what is better than gold, for sure stocks, for sure real estate, I would put crypto as a better investment than gold these days. And if you're really worried about, one, inflation, and two, the market going down, because that's really what people are scared of, then buy bonds. You're more than safe and secure buying a total bond market ETF. And I'll go ahead and recommend one to you. This is Vanguard's Total Bond Market Index Fund ETF, ticker symbol BND. If you're worried about inflation and the market going down in the near term, then this is an excellent opportunity. This will protect you from a downturn in the market while still having a great fund performance that will outpace yearly inflation. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In the event you're invested in gold, if it's a very small percentage of your portfolio, don't worry about it. If I ever become a millionaire, then I'm going to buy maybe a gold brick or some gold coins for fun. I think it would be interesting and kind of exciting to have, but should this be a significant percentage of your overall portfolio, and I just can't rationalize it based on the historical data. Till the next video, guys, take care.